Welcome to my YouTube channel where I study the best investors from around the world. This week, we'll take a look at the principles from Mohnish Pabrai and how he earned a 25% rate of return on the stock market. Enjoy this week's video. Mohnish Pabrai, a man often known as the Indian Warren Buffett, has achieved an annual average return of 25.7% over the past 18 years. The way he invests, according to Forbes, is he has no interest in companies that look 10% undervalued. He knows he isn't going to make it 5 times his money in a few years. If he doesn't think the opportunity is blindingly obvious, he will never invest. You know what? This strategy has worked for him between 2000 and 2018. The assets he's invested in have gone up over 900%, resulting in him managing more than $600 million. So how did he do it? How did he dominate most investors who were struggling to get a 10% annual return, yet alone a 25% return? Stay tuned while I show you how Mohnish Pabrai was able to accomplish such a feat. I will be revealing to you some principles and providing tips which I call the 6 key investing rules Mohnish adopted in order to achieve these results. Note that these principles may not guarantee the same return as Mohnish, but it will certainly help improve your investing for you to get better results. So let's get to the good stuff. Rule number 1, be a shameless cloner. The simplest way to find bargains is to be a cloner, and I'm what you would call a shameless cloner. Mohnish Pabrai. In the US, there's something called the 13F filings, where every quarter, well-known investors are legally required to show what stocks they have invested in. With this, all you have to do is figure out who the smart people are, examine what they're buying, look at their investments, and then reverse engineer or duplicate them. You don't need an analyst. It's actually fun. It is a very smart and obvious strategy from a comfortable position, a niche, but few people do this. So Mohnish's strategy is to find an investor with an investment of interest that has got high returns from the past via 13F filing. It has to be an investment he trusts. He simply copies such investment. So how will you go about it? Let me quickly take you through how to go about it. It's very simple in this modern day and age of the internet. Step 1, visit Google and type in Datarama. Step 2, click on the Super Investors category. You'll get a page of the highest achieving investors who have disclosed what they own legally. For instance, click on Bill Gates. If his investment suits your interest, you will see his main holdings in the stocks he's bought recently. Take the stocks, analyze it for yourself, and decide if it's worth investing.
That cloning is a mental model that can give anyone who does it a huge edge in life. So I think Buffett's partner Charlie Munger talks about mental models, and he talks about the lattice work of mental models, where you overlay different models on top of each other. So if you uncover a truth about human behavior, and it is not generally well understood by most humans, it's going to give you an edge. So one of the quirks about humans is that somehow most humans think that copying or cloning is beneath them. It's something which is maybe not to be done. But actually, the exact opposite is true. If you look at a company like Microsoft, almost everything they have built, and they've built a very successful business, has been cloned from somewhere else. And so, for example, Word came out of WordPerfect. Excel was copied from Lotus. Explorer was copied from Netscape, and Microsoft Money from Quicken. And even now, when they've gone into Azure and the cloud, they're trying to catch up with Amazon Web Services. So even MS-DOS, which was their original operating system, was not built by Microsoft. They actually bought MS-DOS from a small company, and then adapted it and so on. So basically, almost all of the success of the business has come from copying and cloning. The same thing is with Walmart. Sam Walton spent an enormous amount of time in his competitors' stores. And at least for probably the first 20 years of Walmart's existence, there was nothing that Walmart did that had not been done before. And in fact, Sam Walton used to say that he got all his best ideas from his competitors, and so cloning has been really a powerful tool. And I found when I was probably I still have not understood why humans have an aversion to cloning. I don't know why exactly that kind of genetic programming is there in us. But what I do know, because I've studied it for almost 3 decades, that there is a sliver of humans who embrace cloning. And those humans have gotten an unfair advantage in life because they've done that. And so when I encountered Buffett's approach to investing, which was I think in 1994, almost like 27 years ago, one of the things that perplexed me was that hardly anyone followed that approach. So when I looked at the industry, the investment management industry, I had expected to find that they would be following Warren Buffett's approach because he had the best record and he had in an open book format shared the approach he had taken. So it was not secret. He had broadly shared and written about his approach, but all these quote unquote industry participants and experts did not use his approach. So I said, okay, I understand why they're not using it because the same thing happens in many other fields. And it means there's an opportunity. And so I decided I'm going to go all in and embrace it. And it worked really well because there's very few people who do it.
Rule number 2. Buy stocks with a moat. Moat is a deep, wide trench of water surrounding a castle, fort, or town intended as a defense against attack. The term was popularized economically by Warren Buffett, who refers to a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share from competing firms. Mohnish breaks this down as basically the ability of a business to have some type of enduring competitive advantage that allows it to earn a better average rate of return over an extended period of time. Some businesses have narrow moats, some have broad moats, and some have moats that are deep but are getting filled up pretty quickly. So what you want is a business that has a deep moat with lots of piranhas in it. The moat in investment terms is used as an analogy for a business that has a strong competitive edge. Even though competitors come and try and take a piece of the business, that moat is so big and it has so many piranhas in it that it's too hard for competitors to attack what they've created. An example is Facebook. It's not easy for a competitor to come in and replace Facebook because their user base is so strong. Reese's Peanuts, Google, Buttercups, or Ben & Jerry have a hard-to-replicate business because consumers love their products so much. So before you buy stock, make sure that it has a strong moat.
Is the moat intact? Are people still going in? Who are their competitors at that point? I mean, these are the questions you need to answer. How big the runway is, how far they can go, what can happen, and there's a range of outcomes. But you need to be convinced probabilistically that most of that is skewed towards a great answer. Um, and if you look at a business like Chipotle, for example, a lot of people will look at Chipotle and say, uh, what's the difference between Chipotle and some taco stand somewhere? And I think there's a difference. I think there's a big difference between almost all Mexican restaurants and Chipotle. And in my opinion, they've widened and deepened the moat. I mean, in their app is great. They've in the pandemic done a really good job with keeping the business profitable with deliveries and all of that. I mean, the dining rooms are shut down, but they've been able to survive all that, and the infinite customization you can do on it. So there's a number of things there. But again, the question would be, when you look out 10 years, 15 years, what does that business look like? Does it does it become Chipotle's all over Europe, all over Asia, all over Latin America? Does that happen? What are the probabilities of that happening? Who else have enters the space? Will they keep executing? You know, what will be their ROEs in the future? I mean, there's a whole bunch of things that come up. So I think what I'm saying is that you've got to start out with admiring the business and the moat. Like you've got to intrinsically know that. Like even before I look at any ADP numbers, I know it's a great business. Okay, even before I look at any Visa numbers, I know it's a great business, right? So first thing is you've got to mentally have a kind of framework in your head that tells you, yes, I like this business and I think it's great. Um, uh, I think that businesses like Chipotle are harder because they don't have recurring revenue and all these things. I think some businesses like ADP may have more resilience because even if there's a disruptor, businesses are not going to be wanting to change payroll quickly because it's such a small portion of their costs. Like, I mean, for me, you know, messing around with payroll makes no economic sense. Okay. It just irritates me. So I go down these, irrational paths. But basically for most businesses, it's not worth the time of day. It's payroll is running fine, leave it alone. Right. And so those businesses have a much higher degree of resilience, in my opinion, than a Chipotle, right? Because there you got to keep earning the customers' confidence and trust every day, and so on. So I think moats come in so many widely different shapes and sizes, and all kinds of things happen. Boeing, what an incredible moat, and then all hell breaks loose. So I mean, if you looked at Boeing 3 or 4 years ago, you would say this is unbelievable. They've got this huge pipeline. They don't produce a white tail. I mean, just like NVR doesn't produce a home that's not already sold, Boeing doesn't produce an airplane that isn't already sold, right? So there's no white tails, and they've got a big order book, and they're a duopoly, and and they've got a great defense business and all that. It's an incredible business. But look where we are, so such is life.
Rule 3. You make money by waiting. Charlie Munger likes to say that you don't make money when you buy a stock, you don't make money when you sell stocks, you make money by waiting. So the biggest edge that you can get over your competitors would be attitude. The single biggest advantage a value investor has is not IQ, it's patience and waiting. Waiting for the right pitch and waiting for many years for the right pitch. All man's miseries stem from his inability to sit a room alone and do nothing, and all I'd like to do to adopt Pascal is all investment managers' miseries stem from the inability to sit alone in a room and do nothing. So wait for the right pitch, analyze it, and invest if it's worth it.
So one is, I do not want to give you guys any names because one of the things is that I can't, even the Turkish bet could go to zero. Okay. There are weird things that happen in the world. So I cannot have Babson students lose money on something I tell you. So that's just a bad thing, bad outcome to begin with. And the second is that it's a really bad idea to buy something when someone else tells you about it. That's, in general, the starting point is bad. But I would say this, that if you were a know-nothing investor and just getting going, then, dollar cost average, S&P index over time. The important thing about getting wealthy is just two things. You don't need to. So, there are three variables that drive the long-term creation of wealth. Three variables. Okay. So one is the amount of capital, right? How much money are you putting into the pot? The second is the length of the runway. How much time do you have? And then the third is the rate of return, right? So these are the three variables. Now, the thing is that if for most of you, because you are so young, the good news is, and I think most of you may live past 100 because of the way healthcare is going. So the thing is, your runway is like 70, 80 years or more. So you have a really long runway. Okay. Now, the second variable, which is the money you put in. So my younger daughter went to NYU. Despite my best advice, neither of them went to Babson. Such is life. A dad, you can only point the horse to the water. You can't make them drink. So anyway, she was at NYU, and then, she'd come back on these late night flights to California. And one time when she was, I think, 18, and she had just finished working in the summer, and she had made $5,000. So I told her, listen, this $5,000, can we open like a Roth IRA? And she said, yeah, that's fine. And I said, can you give me power of attorney to manage that account? And she said, yeah, sure, no problem. Okay. So I said, look, let's say I'm able to compound that 5,000 at 15% a year, right? Let's say, so there's something known as the rule of 72, which means that you do 70 to divide by 15, which is approximately 5. So at 15%, your money will double every 5 years. Life is all about the number of doubles. So I told her, listen, I told her, Momachi, you're 18 now. What would this 5,000 be worth when you are 68 years old? If I'm compounding at 15% and doubling every 5 years. And, it's like 2 a.m, she's like falling asleep and whatever. So I said that it's $5 million. Okay. So now she's wide awake. She says, how did that happen? I said, well, one double, which means when you're 23, it's 10,000. And then you're 28, it's 20,000. And then you're 33, it's 40,000. So it's doubling. So 10 doubles, which is what 50 years is 2 to the power of 10. 2 to the power of 10 is 1,024. So let's throw away the 24 because I cannot handle complicated math. So we have 1,000. So you have 5,000 times 1,000, add 3 zeros, and that's 5 million. Okay. So, and Uncle Sam doesn't get any of it ever. Awesome. Okay. So, and I said, then, when you're 19 and you do another summer job, and how much will that be when you're 69? And she said, 5 million. I said, oh, that's great. So now we have 10 million. Okay. And then I said, at some point you will graduate and be able to save more than 5,000 a year. So at 22, you might get a job, 70, 80,000 or whatever, and you might save maybe 10,000 in a year or something. And in your late 20s, you might be making 200,000. So I said, what is the total of all these numbers? She said, my head would explode if I could figure that out. Okay. And the numbers become mind-boggling, right? And does it take superhuman amounts of saving? No. You can even reduce the compounding rate. So if I take the 15% down to 10% and I increase the period to 7 years, it's the same thing. It doubles every 7 years, 72 divided by 10, right? So 7 years. So if your runway, so instead of a 50-year runway, it was a 70-year runway, the end result will be the same. So the bottom line is we don't need great stock picks. That's not where the game's at. Because if I give you one stock pick, it'll run out of steam in 2 or 3 years. Then what are you going to do? I won't be anywhere to be found. Okay. And then you'll be wondering, hey, where do I get my next stock pick? So forget all that. Put it in the S&P. You'll own Apple and Amazon and all these other great businesses, which is just fine. And set it and forget it. And that's it. You're done. And the more important thing than which stock is your savings rate. There's a guy called Mr. Money Mustache. Raise your hand if you've heard of Mr. Money Mustache. Nobody has heard of Mr. Money Mustache. Oh, one person, one enlightened person who's a major ardent. Are you a fan of Mr. Money Mustache?
I love Mr. Money Mustache.
Yeah, I'm a big fan of personal finance.
So can you please invite Mr. Money Mustache to speak to you guys. Okay, tell him I told you to get him over. Anyway, so Mr. Money Mustache was a software engineer. Okay, so now he has a blog and he's got big following and whatever. But when he was a software engineer and he graduated at 22, and I'm sorry I'm going over, I know, but hopefully that's okay. We'll be done in a few minutes. I hope that's okay. So anyway, so when he was graduating with his computer science degree, he knew that the gods were not so benevolent to land him at Snowflake. And then he just rides that coattail into becoming a billionaire. He knew that that was not what was going to happen to him. So he figured out, he assumed that when he graduated, he would get a generic programming job somewhere and playing a generic salary with a generic basic bonus, living a very generic life. And his goal was that when he turned 30, that he would be financially independent and he would no longer be working. That was his goal when he graduated. So he said, I've got 8 years and I'm not going to be making high incomes and I don't need a great amount of comfort and such. So for example, Mr. Money Mustache would not be caught dead in a Starbucks. Okay. I mean, $4 for a latte, that's not happening for him. I mean, he would just, he would choke if that ever. For him, it's like more like 5 or 10 cents max for beverages in a day. Okay. So, and the thing is, like, people graduate and they tell you, okay, spend 1/3 of your income on housing and all that stuff. That's only for the mass uneducated majority. So if you go to his blog, you will understand what frugality means. Okay, like he lives on like $8,000 or $10,000 a year. A new car, not in 3 generations would he ever buy a new car. Okay, a 3-year-old car, no. And so, like now he's in the woods of Colorado somewhere. So he retired at 30. He made a lot of money. He retired because he had no expenses. And he's a carpenter on the side. So he built himself his own wood shack in somewhere in the middle of nowhere in Colorado. And lo and behold, in his 20s, he met Mrs. Money Mustache. Okay, Mrs. Money Mustache is even more dedicated than him. She's even more frugal than he is. So it's very important that if you're going to be Mr. Money Mustache, that you find Mrs. Money Mustache. Okay. So now the two of them, completely financially independent, quit their jobs. He bikes everywhere for everything. And I think his annual consumption of gas is like maybe 15 gallons a year. Okay, like 1 tank a year. So to get really wealthy, the important things that you can control, because there are things that we can't control. We can control our savings rate. Okay, we may not be able to control our income, we can control our savings rate. You can also control the runway because you can just assume I'm giving you an 80-year runway. The gods have told me to give it to you, so I'm just giving it to you. Just a very generous guy. So you've got the 80-year runway, you've got the high savings rate. We don't know the rate of return, but it doesn't matter because Mr. Money Mustache got it done in 8 years and he's quite happy. So anyway, you can visit his blog and then you might not get any useful work done for a while, but that's okay.
Rule number 4, don't engage in short selling. Why would you want to take a bet where your maximum upside is double and your maximum downside is bankruptcy? It never made any sense to me, so why go there? Don't invest in a doubling scheme. Don't invest in gambling. In short, do not invest money in uncertainty.
If you look at the top 10 wealthiest people on the planet, top 20 wealthiest people on the planet, top 50 wealthiest people on the planet, I don't see any short sellers in there. And if shorting is such a great activity, why don't I see these awesome short sellers in the Forbes 400? Why don't I see them there? that list is dominated by people. It's dominated with people with two characteristics: people who are long only and people who are non-diversified. For example, my hero, Sam Walton and the Walton family, and so on, and or Bill Gates and or Jeff Bezos and so on. These are all long only players. So if you're mathematically inclined, on paper, it looks really nice that I can go long 10 stocks that I think are undervalued and then short 10 stocks that I think are overvalued and, create alpha and all of that. And there are some people who are very gifted at that and who can do very well. But the issue with shorting is that it comes with a need to be really good at risk management. Let's say, for example, you shorted Tesla at $50 a share. So typically what a short seller would do if they knew what they were doing is each time Tesla went up 10% in price, for example, they would cut their short position by 10%. So by the time it got to 100 or something thereof, they're out in effect, right? That's how you manage the risk, because as it's going up in price, your losses are, magnified quite significantly. On the other hand, typically the way they manage it is that if Tesla goes down in price, as it goes down in price, they increase the short position. So if they're shorted 1,000 shares at 50, they at 45, they might make it 1,100, and at 40, they might make it 1,200. And so you're typically playing this game where you're doing this. And I think even the best short sellers, the way they measure their results, they would say, look, if the S&P long term has done 9% a year, and I have long term lost 3% a year, it's an exceptional result because I created 6% alpha. Well, I don't see how that gets you on the Forbes 400, other than by convincing people to give you fees for losing 3% a year. So shorting is just something, I have a couple of gurus, Warren and Charlie. What they say, for the most part, makes a lot of sense to me. They say specifically when they had companies that they believe were great short candidates, they were almost always right about the company, but always wrong on the timing. And so it's really hard to get both the timing and the direction correct. So it is so much easier to make money on the long side. The other thing is that if you're short, you got an umbilical cord linked to a quote machine. Okay, when the market's open, like I have no idea what's happening to my portfolio right now. I mean, I have no leverage, I have no shorts, and quite frankly, it's irrelevant what happens today or tomorrow or next month and so on. And even if I never got to see any stock quotes, it's perfectly fine. That is not how a short seller lives his life.
Rule number 5, low risk, high uncertainty. The low risk, high uncertainty is really something I borrowed from entrepreneurs, the Patels in India or the Richard Bransons of the world. Basically, if you study entrepreneurs, there is a misnomer. People think that entrepreneurs take risks and they get rewarded because they have taken that risk. But in reality, entrepreneurs do everything they can to minimize risk. They're not interested in taking risk. They want free lunches and they go after free lunches. If you study entrepreneurs from Ray Kroc to Herb Schultz at Starbucks, even Buffett and Munger, what you'll find is that they've repeatedly made bets with low risk and high return possibilities. So they're not going high risk, high return. They're going low risk, high return. When I'm looking at an investment, I look at it the way that I looked at my first business. The first thing I look at is, how can I lose money on this? Can I absolutely minimize my downside? The upsides will take care of themselves if all is planned appropriately. It's the downsides that one needs to worry about, which is why a checklist becomes important. But the important thing value investors focus on is downside protection, And that's exactly what entrepreneurs focus on. What is my downside? So, what is my downside? So I would say the crossover between entrepreneurship and value investing especially is protecting your downside.
Sometimes I end up in situations where eventually it becomes a binary outcome, or it's gone south. So that's a different situation. But I do try hard at the outset, before the investment is made, to try to figure out what could go wrong, and if those things go wrong, what could happen to our investment results with the position. And generally speaking, we try to not go into situations where, so investing is probabilities. I think any business has some probability of a zero. It could be very small, but it's not non-existent. So every business has uncertainty in the future and could have serious difficulties in the future, which may not be predictable. So we can't just say that something is an absolute. Investing is a game of probabilities. What we do want to do is we want to try to maximize the probabilities of a good home run and minimize the probabilities that we have a permanent loss of capital. So if things don't work and I end up with approximately what I started with, that's a great outcome. I would take that bet all day long. And if things do work, then I get a multi-bagger. So if that's the kind of equation I'm looking at, then that equation is very attractive. If the equation is that there's a significant probability of a zero, coupled with a very high also probability of a multi-bagger, that's not of that much interest. So we definitely want to have downside protection. Sometimes we end up in situations, Horsehead is an example. At the time the investment was made, it wasn't a risky investment. What ended up happening is that they were trying to build a new plant, which continuously kept getting delayed and had cost overruns. In the meantime, they had shut down their old plant. And in the end, they ran out of runway, where the zinc prices collapsed and all their financials went upside down. So it's definitely within a bell curve of probabilities, but I did not expect it to go to that extreme end of a bell curve. But we learn, so one of the things I learned from that experience is that you just cannot assume that when managements embark on these, ambitious new plants and things like that they will go as planned. You have to put in a margin of safety. I have another investment right now, for example, a company in India called Rain Industries, which has again been building some new plants and such. And they've had some cost overruns and some delays. But it has not impacted the business because the size of those investments relative to the mothership is well understood. And even if those plants if it was a zero in those plants, for example, the business would not get affected. Business would still survive and thrive. And so that was missing in the Horsehead situation. The what if this doesn't work at all? So we live and learn. And so that was a good learning that came out of that.
Rule number 6, have a checklist. A checklist is a list of items required to be done or points to be considered. It's often used as a reminder. You need a checklist. Checklists show what could go wrong with an investment. The checklist I have currently has about 80 items on it, and even though 80 sounds like a lot, it doesn't take a long time. It takes about 30 minutes to go through the checklist. What I do is when I'm starting a business, I go through my normal process of analyzing the business, and when I'm fully done and ready to pull the trigger, then I take the business to my checklist and I run it against the 80 items. If there are questions for the first time I run it, there might often be 7 or 8 questions I might not have an answer to. Then instinct tells me that I need to find out the answers to those 8 questions first. This means that I have more work to do. So I go off again and find those answers, and when I have those answers, I come back and I run the checklist again. You need to know that any business that you look at is going to have some items which the checklist will raise red flags for, but The good news is that you're looking in front of you and all of your facilities and the range of things that could possibly cause problems. After looking at the list, compared to how those factors correlate to the rest of your portfolio, does this risk fit my portfolio? At this point, you have a go, no-go point where you can say, I am comfortable with the risk factors here and I'll go ahead with it. For Mohnish, his checklist was created looking at his mistakes and other investors' mistakes. For example, he asked questions like, can this business be decimated by low-cost competition from China or other low-cost countries? Is this a win-win business for the entire ecosystem? Is there too much leverage in the business? Is the business competent enough? Unions and collective bargaining. So for example, if there's some company doing high interest credit cards and they make a lot of money but not exactly helping the society, you might pass on that. Or if it's a liquor company or a tobacco company or a gambling business, those can be great businesses, but Pabrai would just pass on those. So the checklist will focus you more towards playing the center court rather than going into the edge of the court. There's also a whole set of questions on leverage. For instance, how much leverage? What are the covenants? Is it recourse or non-recourse? There's a whole bunch of questions on management, on the interest of management, on investments, and historical track records, and so on. Additionally, there are a number of questions on unions, on collective bargaining, and all of the questions were not questions he created out of the blue. What he did was look at businesses where people had lost money, and then he looked at how they failed. For example, he looked at Dexter Shoes, where Warren Buffett lost money, and how he lost it to low-cost Chinese competition. So all these led to questions that he looks for in Court Furnitures, which was Charlie Munger's investment, and that was an investment made at the peak of the dot-com boom, where they were doing a lot of office furniture rentals. Some other questions will be whether you are looking at normalized earnings or at boom earnings. These are questions from the checklist. I think the checklist questions are very robust because they're based on real-world arrows people have taken in the back. Investing is a gentleman's activity. Mohnish actually considers himself a very lazy investor. He calls it a gentleman's activity and that it should come from a place of leisure. This is interesting because almost everything taught on investing is about hard work and constantly analyzing new stocks and listening to CNBC or Jim Cramer every day, but Mohnish says no, you don't have to invest that way. He says, follow what's worked throughout history. Simple principles that have worked throughout history, created by some of the greatest investors of all time like Warren Buffett and Benjamin Graham, and the key is to be patient and just stick with these principles, and you could get some very high returns. So do you think you have the right temperament to be a value investor?
The checklist is a living, breathing document. I just recently added these 3 questions to the Moat section of the checklist. Is it a cinch? Are the feet on the desk? Is the destination awesome? Right? So you already have 3 out of the 170 questions already. The other 167, I'm not inclined to list here right now. But I would say that it's not that difficult to come up with a good checklist. All I did was I looked at how great investors lost money. Like I looked at businesses that Buffett and Munger and others invested in, where the end result wasn't great. Then I looked at were there things known before the investment was made that could have prevented you from making that investment. So the checklist basically asks the question that, for example, Buffett made an investment in Dexter Shoes and it did not work out well, and they got decimated by foreign competition and cheap Chinese labor. So, for example, the checklist question would be: is this a business that could be negatively impacted by cheap overseas labor, for example? Right. So that's a checklist question that would come out from that. And when you look at a business like Amex, the answer would be no. Even if you look at a business like Costco, the answer would be no. But there are there are definitely manufacturing businesses in the US where you would want to ask that question and figure out what the reality is.
I hope you enjoyed this week's investing advice from Mohnish Pabrai. Please like this video and subscribe to my channel so that I can continue to make videos like this for you to enjoy.